Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 9th, 2020. Please see our disclaimer for important information. Well, here in our COVID tracker, provided to us by First Trust, you can see the continuing theme of the last handful of weeks and even a couple of months now. It's been playing out. The 7-day moving average of daily new positive tests for coronavirus continues to escalate. This is something that's been playing out across the globe as we discussed in somewhat detail last week in Charts of the Week. We had some global charts showing the strong rise in cases in Europe and some of the things that are going on in Europe to try to slow the virus. Many countries and jurisdictions are imposing a 1-month slow the spread type campaign. They're closing non-essential businesses. We haven't really seen that yet, and obviously we've been distracted by an election here over the last week. And as that becomes clearer, I think we'll begin to see perhaps some evolution in the policies related to the spread here in the U.S. Now, the good news is, even though that number has picked up a little bit, you can see in the amber colored line, that's a 7-day moving average of daily deaths. That has picked up, but not to the same proportion that we've seen new cases that have been reported. Here's a case fatality rate that's provided to us by covidtracking.com, and you can see that number continues to go down. And this number, as you can see in the legend there, it's calculated by taking the current weekly deaths divided by positive cases that are lagged 2 weeks. And that's typical. Once new case is reported, if there is a death, that usually takes a couple of weeks to play itself out. So good news here is that number seems to be flatlining at below 2%, actually closer to almost 1.5 now. That you see as a tremendous change over a few months ago, back in the late spring and early summer. And we continue to want to see that number remain low, even if we see a rise in cases, especially as we head into the colder months of the year where more people tend to be inside, especially in the northern climes. There is, and you see people that are kind of exhausting somewhat of this restrictions and mask mandates and things like that, and tend to gather in areas where there's other people, and the risk of spread continues to be high. Here's our high frequency data provided to us by First Trust again. And while I would say that the data on balance over the last 2 months has been fairly positive, we have some puts and takes this week and puts and takes this month as we kind of look at things relative to the beginning of October. Now, we know that some of the data, the industrial data, shipping and goods, and basically the industrial sector has been on balance positive over the last month, even though we've had a lot of data that's been down year over year. But if you look at rail car traffic, and a lot of this relates to transportation of retail goods, and we know the goods sales number, consumer purchases of goods have been phenomenal, much better than expected. And so you can see that read through here in rail car traffic. Again, it's not solely related to retail goods, because there's also transportation of aggregates and other commodity type things there, grains that are being shipped and so on and so forth. But we have seen positive rail car traffic year over year, as well as month over month, even if that data has been a little bit noisy over the last week or two, and we're down slightly. But box office receipts, again, that's a function of really the continued restrictions and the fact that there's frankly nothing that anybody would want to go see that's been released, as most theaters have kind of pushed out their release schedules until 2021. Hotel occupancy we've seen a little bit of a retrenchment there, and just talking to a few local hotel purveyors that kind of echo this sentiment that it's tough to get the business traveler out. That's probably what's going to happen first, and then you've got leisure that's obviously been continuously impacted, and probably will be for some time. And then restaurant data, as we see the rise in cases in some jurisdictions going to increased restrictions, that's been impacted. TSA checkpoint data off over the last week, as well as driving overall, as echoed in the supply of motor gasoline. So I think this is really echoing this broader sentiment that we're kind of slowing down a little bit heading into the holiday season. Obviously, it's going to be important to see what really happens around Thanksgiving, which is traditionally a phenomenal, not only shopping experience and period, but also a travel experience. And I think last week in Charts of the Week, we talked about kind of this dichotomy of opinion that's evolving right now on what's really going to happen with holiday shopping this year. I think there's a consensus that it's going to be perhaps weaker, but maybe more heavily skewed to online purchases. And, those are things that we just don't know. And I think we have this general care and concern over consumer spending in general as it relates to a large part of the population that has been spending. These are people that have been receiving stimulus dollars, and a lot of those programs, as we'll see in a couple of charts here, are going to expire, and a lot of renters that have received forbearances on their lease are going to see those forbearances or the exemption from or the preclusion from eviction, those types of things going away at the end of the year too. So it's going to be very interesting to see what happens to consumer spending overall. But we'll continue to supply you with the high frequency data as we get into the weeks and months ahead. Here's the chart on small business jobs. I can't echo this enough. There's a lot of pain being suffered in the small business sector. We talk about it just about every week. And I'm consistently looking for data that gives us perhaps some signposts and some additional perspective on the troubles within the small business sector. And here's just one from Paychex. That's co-sponsored by IHS Market, and this is their index indicator, if you will. So you can see how it's evolved. We've seen small business jobs really undershoot here related to the pandemic, but they still remain very weak. And this is something that we'll monitor consistently through the end of the year. This is a chart that kind of highlights, even though it's not necessarily as current, but it's from the Bureau of Economic Advisors, and it shows you the savings rate versus disposable income. And this is fairly intuitive, but as these stimulus programs wane, you're seeing a consistent trailing off of both the disposable income that people are receiving, and a lot of folks that were unemployed were receiving not only the $600 a week checks, but you saw people in April receive all the $1,200 per person, and so that's obviously gone away, replaced by something that's a facsimile of what we saw earlier this year in the pandemic, and that number continues to trail off. And when we add September and October to this data, when that data is readily available, you'll see that number continue to trail off. And the interesting thing here is that if you look at where March is, and again, the savings rate picked up out on the eve of the pandemic, and remember that this was COVID-19 was declared a pandemic really towards the end of February. So you can see why that March number picks up considerably, even if those programs to put money in people's pockets really hadn't kicked in yet until April. But as we trail back down, it'll be interesting that savings rate of roughly 10%. It's actually not 10, but it's about 7 to 8% on a consistent basis that we saw kind of towards the end of last year. As it would be interesting to see how long it takes us to migrate back down to that level. And obviously there's a lot of things at work here. There's a lot of different ways to cut this data, and there's different socioeconomic levels. And the people that were at the upper income cohorts tended to save a lot more of their income in preparation, whereas people at the lower income cohorts were much more inclined to spend that money and consume. So we'll be updating this type of data consistently through the end of the year as well. A quick comment on the mortgage industry. We've seen a lot of issuance. We have data on this, and we've shown you some interest in some interesting charts that we've come across over the last several weeks here. But you can see a rise in delinquencies. And this is a time series that goes back a long way. So just be clear about that. And all I want to do with this is to kind of show you relative to the 2008 housing crisis where we see, because everyone's been talking about the strength in the housing market, and that's true. We've had prices, we've had low interest rates, so housing affordability has gone up. But at the same time, we do see the stress in the market for borrowers that have frankly struggled. Small business owners that have mortgages and things like that. And so, we're not quite as high as where we were in the 2008 housing crisis, which was a tremendous spike in delinquencies, but we're not too far off of that level. This is a chart that kind of talks about that renter conundrum that I alluded to earlier, and there's a lot of data on here. It's frankly probably worth having both the upper and the lower having its own slide here, but really the focus is on the top side. And you just look at confidence levels on consumers, on their ability to pay. And if you look at no confidence, that's a fairly stout number. That's almost 6 million people. And then a slight confidence, that's another 8 million people. And then you get into moderate confidence, that's 13.5, and that gives you a little bit more comfort. But that's folks that are not fully confident, that perhaps are uneasy over some certain factors, maybe potential loss of a job or potential other cash flow impacts. So, if you add those together, that's over half of the renting market that has some fear over being able to pay, and at worst, an absolute confidence that they cannot pay. And so that's pretty profound. Again, we'll need to see how this plays out over the next 3 months, because a lot of these forbearances and eviction preclusions go away at the end of the year. Here's some data related to employment. This is from Morning Consult, and it represents the percent of the U.S. adult population who lost pay over the last week. And so we've had, this is just another chart that kind of highlights the troubles that we're seeing in the labor market overall, even as we see unemployment rates go down to a degree, and we see jobs. The labor market and the interest in hiring is there, but it has to dovetail with the ability for businesses to want to expand. And right now, we're still in a little bit of a state of challenge. I mentioned the housing market a couple of slides ago, and without a doubt, it's been strong. You can ask any of the higher functioning real estate agents in most markets, not all markets, but certainly here in Central Texas, that's been very strong. But this is really a comment about the sustainability of housing, and this is a national number from Piper Sandler in one of their research reports, and it's housing starts to population, and it's really well, it's below average. So what does this really mean? What can you take away from this? And that just means that we're in a housing stock problem. So we're not starting as many houses as we need to support the population growth and certainly the population in aggregate. And so this, I think, gives us some comfort that we're going to have some staying power in the residential real estate market. First lien mortgage originations. This comes as really no surprise to any of us that we've seen a pickup in the mortgage market. Now, we know that credit is available to borrowers with means, or I should say certainly with reasonable credit and the ability to pay, but you can see the huge spike in refinance as we've seen low interest rates really take root here. Here is the quick picture of the ISM manufacturing inventories. Now, this is not the Institute for Supply Management Index, which is an indicator of activity. This is actually the inventories. And so the reason I'm showing this in lieu of the ISM number as a standalone is that the inventory levels are extremely low. And a lot of producers have kind of pulled back on manufacturing for a lot of different reasons. Several months ago, it was frankly related to the fact that they couldn't keep some plants open because, half their workforce was infected. But, now it has probably more to do with wanting more visibility in the economy. I think there's a certain level of confidence that's building within the C-level or C-suite ranks in terms of CEO confidence, but it's yet to manifest itself into increased production. And I think when we see the next round of stimulus that will get approved, and we could sit and debate on what that might look like, but we won't know until we have resolution as to whether the GOP controls the Senate or not, and we won't probably know that until January. But anyway, having said that, I think inventories are really low, and this is not an insignificant component of the economy. And so I highlight this to show that that there's a snapback opportunity for growth when there is greater confidence in the overall economic backdrop, that producers will have the confidence to increase production, and that will have certainly a beneficial impact on the economy and on GDP. Here's a quick shot of the commodity market. These are it just shows you the dichotomy. If you're a commodity investor, that there's a huge gulf between the haves and the have-nots, if you will, in the commodity space. And obviously petroleum, we know, has been very weak. We know that those prices are trying to find a home around $40 a barrel in West Texas Intermediate crude. But crude prices are well off year over year. We know production's off. We know rig counts are down and trying to stabilize. But at the other end, we have precious metals, and that's been a hedge in an environment where, as you'll see in a minute, we have negative real interest rates. And while we don't have inflation, but we do have some questions with regard to investors have with regard to finding stores of value that are reasonable. So this is just a chart that shows you that relative to a year ago, that precious metals are up strongly. Petroleum, as we know, is down, and overall commodities are off a little bit in terms of the index. But I've got a really good feeling about the commodity basket as it relates to the 2 to 4 year outlook. This is a quick summary of what I'll call real yields from GaveCal Research and Macrobond. And the oddity here is, say what you will about China, and there's a lot of negative rhetoric around China, but China in its authoritative state has gone a long way to kind of controlling the spread of coronavirus, and their numbers don't look nearly as bad as they do in Europe and other parts of the world, and certainly here in the U.S. But this is interesting that this is a real yield number. So these are nominal sovereign rates of interest on sovereign bonds deflated by realized inflation. And you can see the U.S. we have a negative real yield on the 10-year bond of approaching 2%, and really China is the only place where you have a positive real yield. So as it relates to the prior chart, obviously negative real yields and low yields tend to deflate currencies relative to those who have positive real yields, and it also tends to sink your dollar, as we'll see in just a second. Here is the dollar spot index. You can see that we've had some noise in this. There was a flight to safety in April, so that's the reason behind that spike in 2020. But as you can see, those real yields trending negative and approaching that negative 2% level, that it's really put some pressure on the dollar. And we think that that's probably going to settle out here in the next year. But as it were, while it is weaker, what that implies is it's better for exports, it's better for commodities, and it's better for asset inflation, and so this is, like I said, something that I would expect to see kind of even itself out over the next year, certainly, but I think the aggregate dollar level is going to remain lower than it was last year for quite some time, and it will have, I think, a unique influence on real and financial assets, and as well as net exports, perhaps even during a period of declining overall global trade. And as you might expect, this is your 10-year U.S. Treasury yield. Now, it had been trending up close to 92, 93 basis points, and now we're back off of those levels, kind of getting back to close to where we were at the beginning of October. Here's our stock market. We have had a very strong week, perhaps the strongest week that we've seen since April in our recovery here. And but you look at that purple line, that's kind of that trend that we're kind of coalescing around. And you've got a 50-day moving average, which we just punched right through during the middle of the market. If you look at it from a technical standpoint, that's positive, probably not as positive as would be the case of punching through a 200-day moving average. But having said that, you can see the volatility in the market just over a period of the couple of months. September was a challenging month, and then October had a good early start, as the end of September did, but then we trailed off, and now we're in an uptrend as some of these unknowns and variables in our society, our government, and our economy play themselves out. I wanted to show this. This is from J.P. Morgan, and this is kind of breaking apart the S&P 500, the valuation levels. And I've talked about the valuation being certainly higher than it has been. And this is a trend series, a data series that goes back to 1996. If you look at the post-financial crisis, you can see that those valuations were exceptionally low. They picked up consistently during this recovery, and then it had a bit of a gyration as we had 2018. We had some serious market correction events that kind of brought those back in line at a time where profit margins were beginning to stall out. But you can see where the E in price to earnings, the earnings and price to earnings has gone down, and that's inflated our PE ratios, or market valuations, essentially. But if you take off the top 5 stocks. And we know we've been talking ad nauseum over the last 6 months about the impact of FANG, the Facebook, Alphabet, so on and so forth our in our stock market indices. If you back those out, the market valuation is frankly not that obtuse. In fact, it's actually quite reasonable relative to average. You might even argue that if you back out the top 5, the rest of the stocks are below their long-term average of about 16 times earnings. And currently, they're not too far above that. Certainly not so much if you, certainly less than if you add those top 5 stocks, and that pushes the valuation over 20 times. So I think an interesting analysis here that breaks apart the 495 stocks in the index from the outsized influence of those top 5. Negative equity. Now, there's always puts and takes to the story, and this is something that I've monitored. We've talked about a rise in corporate debt. We've seen default rates not pick up, but we've also seen a huge rise in net debt to profitability. And here's a symptom of the increase in debt in the corporate environment. This is S&P 500, but S&P 500 liabilities exceeding assets is near a peak. And so again, I'm not overly concerned right now about defaults, but I'm watching it because this is a trend that's been in the making for several years, and then now we've got this pandemic. So I think it becomes a bigger risk if we have an economic stall next year. If there's delays in achieving a vaccine response that kind of gets us back to normal, which I think it will need a vaccine to do that. But if that stalls, then I begin to worry about data like this a little bit more. This is our volatility in the market, and as you can see that we've kind of saddled around current levels. We had a little bit of a pickup in this latest sell-off, but then that's been rolling over a bit as we've recovered over the last several weeks here. And in the last couple of last few charts here, I just thought I'd offer a few items of kind of general interest. But as we just exited this election cycle, and I realize that the presidential election, even though we have a presumed president-elect, there's still some hair that needs to be resolved here. But you can see just this animosity that's been building over a period of time, and this partisan divide that's been building over quite some time. And I look at where we are in this pandemic, and how this number can help foment civil unrest. It can foment really inflexible attitudes, and when you have that, it kind of gums you up a little bit in being able to generate fiscal policy that's productive and efficient. And as you look at this trend, especially the chart on the bottom where there's a less favorable impact on the other party, and this is Republicans and Democrats. So, I think this is something that we're just going to have to live with, because it looks like it's clearly a trend that's not going to go away anytime soon. Election turnout. This is no surprise. This is well documented. I just found this in Statistica and thought it was really interesting that you got to go back a long time to see the kind of turnout that we have here. And I think it's profound. I think it's a great thing, actually, but it's just really profound in its magnitude. Again, despite the fact in that last slide, it shows you that there's a lot of animosity between the parties. You're seeing a higher voter turnout, and that's, I think, frankly, a very good thing. And for those people, finally, who are interested in kind of the environmental issues, if you will, I showed a chart that was like this several months ago, And this is from Daily Shot, and it shows you a trend series going back to 1900 on annual change of carbon dioxide emissions. And obviously, you know, as we've industrialized and more people are driving and so on and so forth, you know, that number consistently picked up. But during the pandemic, when we were taking people off the roads, and more people are working from home, which I think, frankly, will be a trend that we'll be embracing over the next several years, that number's really dropped. And not just, you know, not just a brief reset. I mean, this is a transcendent type number. And, you know, I'm going to be very, very curious going 2-3 years down the road and seeing what that number looks like relative to the last 20 to 30 years. It'll be very interesting, and so just an item of interest. Well, that will do it for Charts of the Week this week. Hope you've enjoyed it. Please reach out if you have any cares or comments or questions at the information you see here. Hope everyone gets your flu shot, and everyone's safe. Have a great week, and we'll talk to you again soon.